It looks like we do have some people that are joining that do not speak um, Russian. So why don't we guys do this in English?
Okay.
Let me just start presenting from the beginning. Can everyone see my screen?
Yes.
Okay, perfect. Let's get started. Hi, everyone. We're happy and grateful that you're able to join us for our live webinar, How to Utilize Retirement Funds Investing in Real Estate. Today, we're going to specifically talk about how to utilize a strategy that many people are not aware of. Real estate investing can be done utilizing cash as well as retirement funds. We have brought our featured speaker, Dmitry Fomichenko, but why don't we get started with quick introductions. I'll do an introduction myself. My name is Alex Kholodenko. I'm located in Silicon Valley in the area, originally from Ukraine. I have immigrated 25 years ago. I have tried various strategies in real estate investing. I started in single family homes, like a lot of people typically do. I have tried money lending for fix and flips. I have partnered up with other people as well to do some flips as well. I have built new homes with partners. I work in Silicon Valley as a tech professional, and I invest passively in real estate. Over the last 5 years, I have built a diversified portfolio in syndications, which are passive investing and group investing strategies such as apartments, hotel, and storage units. And I help others to do the same. And we'll briefly touch on that, how this structure works. I believe that the busy professionals deserve direct access to wealth strategies, and we're here to showcase you and give you some examples of different strategies that have personally worked for us, Tim and Dmitry as well. And you can learn something and apply some of these strategies, and have Q&A questions toward the end. So if during the presentation, if you have any questions, please type them in the Q&A, or if you are joining us on Facebook Live, please type your questions and we'll be able to address them either as we go along or as toward the end of the presentation. Tim, why don't you go ahead and introduce yourself as well?
Okay. Hello, everybody. My name is Tim Yusubov. I've started my career as a software engineer over 25 years ago. I specialized in different developing and architecture of software and engineering. And a few years ago, I would say probably in 2016, I started back actually in 2005 with small family houses, buy and hold, fix and flip. And later on in 2016, I transitioned into multifamily, and this is where I've been ever since. So I specialize in consulting, underwriting, and syndicating real estate transactions. And I'm an actual operator and a sponsor on small, medium, and probably semi-large multifamily real estate investments. I run a company called the Elite Capital. We are actually in several markets, including DC, Maryland, and Virginia, as well as Nevada, Florida, and a little bit of Pennsylvania we're trying to expand to right now.
Yeah, so I just wanted to quickly explain to you what syndication is. I think a lot of people are familiar with it. Some of you are not. The goal of Tim and I and Dmitry is to showcase different strategies that work in real estate. There are several of them. Typically, the syndication model works in such a way where a group of investors form LLC and acquire larger type of properties. We're talking about 100+ unit apartments, sometimes hotels, sometimes storage units of 400 and above. And it is a very unaffordable solution for somebody to jump in and come up with a down payment on their own for larger properties. So the idea behind such a scenario where you and other investors can come in as a group, typical investments are in a $50,000 to $100,000 range, and can acquire larger properties and able to receive not only cash flow with distributions that are paid out either monthly on a quarterly basis, but an additional upside. These properties are professionally managed by our partners and ourselves. We have done quite a bit of such investments, so we have a personal experience. We invest in every deal ourselves. We vet out the operators, and when we find deals, we recommend them to you as a potential investor. And the major difference between syndication is, I just want to mention that it is a totally passive investing. So if you would like to be investing in real estate, but do not have time nor expertise to do that, you could become a passive investor into larger syndicates, such as apartments, hotels, storage units. You will become a limited partner. You have very limited minimal time investment. And you also have to be okay with a limited control of that, because obviously the operator, a lead syndicator, is in charge of managing the assets, making improvements, and eventually selling the asset for profit. They do have majority control of that. We understand that there's different type of strategies. This might not work for everyone. There's some income requirements for that as well. You have to have a certain income in order to qualify to invest in such properties. We have a very high demand for such opportunities. You could invest in single family homes. You could do Airbnb with them as well. You can rent on the long-term basis as well. So this is one of the strategies that we are recommending, that we've had good experiences with, that require very little time from your end. And you can tell or ask us for additional questions as we have a future presentation. But we don't want to take too much time from going forward. I'd like to introduce our good friend, experienced investor and tax expert, Dmitry Fomichenko, who will go over the benefits, how you can utilize syndication model or other model to invest in real estate utilizing what's called self-directed retirement account. Dmitry, please take it away.
Thank you, Alex. Before I jump into my presentation, since you guys gave a little bit feedback on yourself, I think let me spend just a minute to give you a little bit about my background.
Please do.
I've been here for 24 years, will be this October. Moved here from Russia, have background in electromechanical engineering, worked in the field for a few years, and then I got introduced to the concept of real estate investing. And just like Alex and Tim said, also started in single family homes. I did a few fixer-uppers. I'm a handyman, did a couple of fourplexes, started in the year 2001, 2002. It was really great time. My first two investments more than doubled in value. Used that equity to start buying new properties out of state, because in California it became very expensive. And then when I started Sense Financial Services 10 years ago, I did not have the time nor desire to really put towards my investments. So I started changing my strategy, and I transitioned into private lending, and it worked great. I was doing private loans, both personally with my personal savings as well as my retirement funds. And it worked great for retirement, but for personally, the more loans I made, the more interest I received, the more taxes I paid because I did not have any deductions. And so I started looking at different strategies. I wanted to get back into real estate, physical real estate, but I didn't want to deal with the management aspect and tenants and so forth. So I started investing in syndication, and that was a major change to my bottom line, because now I was able to capitalize on the tax deductions as well. And tax savings were tremendous. But if you can go to the next slide, please. What we do is we help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work leads to prosperity. And that's what we do. We want to partner with you, help you gain that control, and so that your hard work can lead to prosperity. As we go to the next slide, just wanted to give you an example. This is Jason, one of our clients. He actually contacted us. He was he had a couple of different retirement accounts, and IRA and 401k valued about $135,000. Was actually looking at his account statements, balances, and was looking as his balances were going down. He was losing money. And I'm sure most of you can relate to that. You don't have to go back far. Just go back to the beginning of this year. If you have any money in the stock market, you've seen the drop when the pandemic hit, the drop in the stock market. And back in 2007, I've seen some of my clients lose as much as half of their portfolio. So if we can go to the next one, please. One more, couple more clicks. Okay, so he contacted us. We set up a self-directed solo 401k, and he was able to make the following investments. He purchased a rental property in his 401k. So his 401k now owns this property. He invested with his brother. His brother is serial entrepreneur, started successfully and sold several businesses, was working on another startup. He invested with him. Please note that if there is a private business, if it's not publicly traded, you cannot use your normal or conventional IRA or 401k to invest, but with the self-directed, you can do so. And then the rest of the money he actually invested into real estate notes. So he essentially became a bank. So these investments, they produce $1,000 a month for him. And not only that his income is stable, but he's also receiving, he's also has assets that will appreciate over the time. So that's kind of the comparison of what he had before and what he has now. As we move on to the next slide, the options that I want to cover today when it comes to self-directed is self-directed IRA, checkbook IRA, and a solo 401k. So I'll spend a few minutes on each. As we go to the next slide, the comparison between the conventional retirement account and self-directed retirement account. If you have an IRA or a 401k or maybe 403b if it's with your employer, those accounts are held with the custodian, and custodian has the power to limit your investment options. And the only options that you have available are confined to the stock market, stocks, bonds, and mutual funds. Next, please. Here's just wanted to give you an example. When I worked for a company, the representative will come on and meet with us about once a year, give us a sheet similar to this one, showing us the investment options we had available for our 401k. As you can see, again, just a few mutual funds available. Now, as we go to the next comparison between or showing the options for a self-directed IRA, with self-directed IRA, you have virtually unlimited investment options. Now, what you can see here on this list is just most common investments. It's not by any means exhaustive list. Those are just some of the most common options. So you can invest in real estate, residential, commercial, single family, multifamily, tax liens, tax deeds, cryptocurrency over the last few years, mortgage notes and trust deeds, and so on and so forth. There is a few limitations we'll cover. I do have a slide on that, but there is virtually unlimited investment options. So as we go to the next slide, let's talk about self-directed IRA. What is it? So self-directed IRA, basically a tax-deferred trust account that is held with the IRS-approved custodian. And custodian, unlike your custodian that you used to, a Schwab or Fidelity or Ameritrade, these custodians, they don't allow, they don't limit your investment option. They allow alternative investments. Majority of people don't know about the existence of these retirement accounts because your stockbroker and your financial advisor, it's not in their interest to tell you. They want to keep you invested in the market so that they can collect their fees. And many of them, frankly, don't they're not aware of that themselves. So but they've been around since 1974. And the purpose of this is to help people like you and I put money away for the retirement. As we go to the next slide, I just wanted to illustrate to you the, if you can go to the next, please. There you go. There's going to be a few clicks here, but basically self-directed IRA, how it works. Step number one is you're going to open a new custodial account with IRS approved custodian. Then as an account owner, you will perform a qualified transfer from your existing retirement account to the new custodial account. So you move your IRA or 401k or 403b. And at this point, as an account owner, you direct the custodian. So you tell the custodian what to do. You can decide which investment to make. And at this point, custodian performs the investment transaction on behalf of your IRA. The benefit of this is that you have now alternative investment options open up for you. But the downside is that every time you do a transaction, there is a fee that custodian charges. Those fees can add up over time. And most importantly is the red tape and the bureaucracy of having that middleman that slows you down. So let's look at the next option, which is a checkbook IRA. The checkbook IRA is, if you're going to go to the next slide, please. A checkbook IRA is an alternative to the custodial IRA. It's also known as a IRA-owned LLC. And the way it works is that there is a special purpose LLC that is created. This LLC is owned by your IRA and it is managed by you. It does require IRS compliant setup and the operating agreement, because remember, it's not just a normal LLC, it's a special purpose LLC created specifically to be owned by your IRA. So it must meet IRS rules to be compliant. But this structure allows you to bypass the custodian when you make the investments. So you don't have to, no longer have to go through the custodian. Custodian is still there. Custodian is required by the IRS for each IRA, but you're able to bypass them and do all the investments inside of the checkbook IRA. The next slide shows the diagram, how checkbook IRA works. So let's take a look at that. Again, similarly, you open a new custodial account and then you perform a transfer, qualified transfer from your existing IRA to the next, to your newly established custodial account. Next, a couple more clicks, please. Then a special purpose LLC is created. This is a single member LLC owned by the IRA. You don't own this LLC, your IRA is the owner, but you're the manager. So as a manager, then you instruct the custodian to buy LLC units. Custodian issues a check payable to the LLC, sends that to you, and then you open a business checking account in the name of the LLC and deposit that check in there. And from that point, another click, please. From that point, you're able to make investments directly into the LLC. You don't have to go through the custodian or a middleman to do the transaction. You can make the transaction as simple or as easy as writing a check. And all of the income and expenses must be coming from the LLC checking account and going back into the LLC checking account, which you control. So there is no middleman. The benefit of this, again, is you minimize any delays because you're in charge of the transaction, and you also eliminate all of the transaction and asset-based fees. As we go to the next slide, let's take a look at the solo 401k, which is also known as the ultimate retirement plan. And it's not a new type of plan. It's been around for many, many years. It's designed under Internal Revenue Code Section 401, subsection K. That's where the name comes in. But a solo 401k specifically designed for those people who are self-employed or own a small business. They've been around for quite a long time, but the increased interest in this was as a result of changes in the tax law in 2002 that made benefits of the solo 401k possible, and we will review them over the next few slides. But let's talk about eligibility for the solo 401k. You must meet two criteria to be eligible. Number one, you have to have legitimate self-employment activity in place. It can be in any shape or form. You can be a real estate agent, attorney, or just doing anything else. As long as you generate self-employment income that you report on a Schedule C, you qualify. And then number two, the second qualification, we can advance the slide, is the absence of full-time employees. Now, the IRS definition full-time is 1,000 hours or more per year. So if you have somebody who works for you more than 1,000 hours, then the law requires that you offer them 401k benefits as well. And solo 401k is not designed for that. So you need a full-blown 401k for it. So those are the two criteria that you must meet to qualify. And at the bottom, I put this. Having a full-time or business with full-time employees is the only thing that will disqualify you from setting up a solo 401k. Now, you may say, well, you don't own a business and you're not self-employed. Well, that's a problem that can be solved. And that's actually, there are reasons you may want to become self-employed. You don't have to quit your job, but you can do something in addition to your full-time job, just create an additional source of income, and also opening up yourself to qualifying for the solo 401k. All right, so let's move on to the next slide.
Yeah, this is very important. I just want to emphasize to people, I think we do have a lot of people that have day jobs, such as myself. So in addition to 401k, which you have at your job, you could have another 401k set up if you have additional business and an income, which is a sweet thing to do. It reduces the income that you receive from your business. So in our case, Tim as well, you know, we have additional income coming in, then we are opening 401k and investing that to reduce that income, and ultimately it results in income reduction from the tax perspective, right? So this is a very important point. And one of the people asked me before the webinar if this is something that is doable. It is absolutely doable. So you could have two 401ks, one from the job and second one specifically for your business. And the business has higher limits that you could invest. I think, Dmitry, you're going to go over how much dollar amount you could invest?
Okay, we do have a slide on that.
Okay, thank you. Let's proceed.
That's a very good point. So you definitely can have more than one 401k. So let's look at the mechanics, how it works. Well, number one, you have to have a plan sponsor. And the plan sponsor is the employer that sponsors the 401k. Now, in this case, it can be any legal entity, including sole proprietorships. You actually don't have to have an LLC or a corporation set up. If you work for yourself as a sole proprietor, that's a legitimate business type that is recognized by the IRS, and you can sponsor a 401k. Now, next, the solo 401k plan is created and trust is created. Trust is used in this case as a vehicle to hold the plan assets. And as a trustee, which you are designated trustee then, you have the control over the plan assets. Similarly, as in the previous slide that I explained, as a manager of the LLC, you control that. Here, as the trustee of the trust, you control the trust. So once the plan is created, then you open a business checking account in the name of the trust, and you can do so at any financial institution of your choice. A bank, credit union, or a brokerage. And then one more click, please. Will show us the illustration that now as the plan trustee, you direct the trust how to invest. So you can, again, the same manner, you can buy investment property, you can invest in a syndication, you can do a private loan. And one more click will show us that all the income and expenses basically flow in from the 401k trust bank account and back into the 401k trust bank account. You cannot commingle this with your personal assets or personal finances because, again, it's a retirement plan. Everything must be arm's length. You must keep everything separate. You control it, but you don't get to use it right now.
And correct me, Dmitry, correct me if I'm wrong, but I think IRS also defines the criteria where you can, who you can invest with and how you can invest, make sure, you know, they're not your friend, your
immediate family members. Yeah, I do have a slide on that. So good question, but we're almost there. So let's move on to the next slide. Let's talk about the benefits at the high level. And I'm highlighting just the major benefits here. Number one, it has a super high contribution limit. For this year, for 2020, you can contribute up to $63,500 into this plan. That's per individual, per participant. Now, if you're a husband and wife in business together, then you can double that. I mean, just think about the bottom line. If you're in business for yourself and your spouse is also involved and you're able to shelter over $100,000 of your income from taxes, what it's going to do to your bottom line? Well, that's going to drop your taxable tax bracket for sure. So now you're going to be paying taxes on, in a lower tax bracket on significant lower income. So the savings can be huge. So this is it's just a great, even just for that reason, it's worth to have this, just for the, to be able to lower your tax liability. Also, it has a loan feature allowing you to tap into your retirement fund should you need it. You know, you may never use that, but just like you might have a 401k at your job and you have the ability to take a loan from that, you can do the same thing with the solo 401k. So basically the rules allow you to borrow from your 401k up to 50 grand or 50,000, whichever is less. You can do it for any reason. And I call this feature is like your own small bank. You're creating your own small bank that you can tap into at any time and access. So it's pretty cool knowing that you have these funds that you can access at any time. Next is the ability to make Roth contributions. Solo 401k has this feature allowing you to make post-tax contributions into Roth, just like a Roth IRA, but different. And how is it different is that Roth IRA has income limitations. So if you're making over a certain threshold, you're not allowed to contribute to Roth. But with the solo 401k, regardless of your income, you can contribute up to $26,000. And then next is it's very cost effective because it does not require a custodian, unlike an IRA. With an IRA, you must have a custodian. With the 401k, you don't have to have a custodian. Now, you can set it up with the custodian. You can go to Fidelity or Schwab or Vanguard and open a solo 401k there. But again, custodian will limit your investment options. Here, you have unlimited investment options, but most importantly, because you are the administrator of the plan, that gives you the control. So again, no middleman. And another, I guess, a sub-benefit of this is that, as I mentioned earlier, if you have a spouse, your spouse can also participate. Can do that with an IRA. With an IRA, which is individual retirement account, you do need separate account for your spouse. Here, your spouse can participate in the same 401k. So there is no additional cost for that. All right, let's move on to the next slide. Oh, actually, before we do, the last point is that solo 401k is exempt from UDFI, which is unrelated debt finance income tax. So if you invest with Alex or Tim, for example, into a syndication, and the syndication uses debt financing, uses leverage, which most syndications do. If you do that inside of an IRA, that will result in UBIT, which stands for unrelated business income tax. And this is a tax that is assessed on leveraged portion of the investment that you're acquiring with your retirement fund. but 401k specifically is exempt from that. All right, so if we can go to the next slide, you can see just a quick illustration here. The credit goes to my daughter. She was about 4, I think, or 5 at the time when she did that. Time flies, but basically, I mean, if you look at this, it's just common sense. The man holding a basket and the bottom fell off and the basket represents the stock market. And, you know, if you have all of your eggs in one basket and the bottom is gone, then most eggs going to be gone. Yeah, maybe a few will survive, but most will be broken. So the point is that you do want to diversify. You want to put your eggs in different baskets so that you're reducing your risk. And you can do that only with truly self-directed IRA 401k. Again, Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. We don't know what's going to happen tomorrow. We don't know the results of the election. We can guess. We don't know where the virus is going to take us or the developments and how that's going to affect the investments. But guess what? If you're going to invest a portion of your portfolio in the stock market and then another portion into real estate and then you know, maybe having a rental and then another portion into multifamily, well, all of those, the result will be different. You're not going to have the same reaction to those. I can tell you that, again, reflecting back in the beginning of the year, when the pandemic hit, I don't have much invested in the market. I have probably less than 10%, maybe close to 5% of my total assets in the stock market, and I've seen about 30% dip, 30% loss from in February, I think. Now the rest of my portfolio didn't change. In the rest of my portfolio, I have a few rentals, I have a bunch of notes, and I have several syndications. Well, none of that has been affected. I think on one of my rentals, the rent was late, but I didn't have the same result as I did with the stock market. Now, thankfully, stock market recovered very quickly, actually, in just a few months. I'm now more than where I was at the beginning of the year looking at my stock market portfolio. But that is very unusual. And I think that's because of the President Trump policies. He's a businessman, so he was able to implement certain policies that helped the stock market recover that quickly. But you have not seen that in the past. I mean, look at the history. Stock market never recovered that quickly. So don't rely on having the same results in the future. Again, the point is you want to diversify. Okay, let's move on to the next slide. Again, self-directed equals unlimited investment options. You can do all of that you can see plus more. Let's advance. So let's talk about the limitations. Now, the limitations are described in the Internal Revenue Code section 4975. And it explains prohibited transaction rules. And according to these rules, you cannot invest your retirement assets in collectibles, S-Corp, and life insurance contracts. So those are the only limitations. And on top of that, next slide shows us that you cannot also invest or engage in any transaction with the disqualified person. So let's go to the next slide. And the disqualified person is yourself and your immediate family members, your kids, grandkids, their spouses, your parents, grandparents, advisors, and fiduciaries, and any business that one of those actually owns 50% or more interest. So remember that. And the easy way to remember that is a vertical line, okay? So your parents, grandparents, your kids, and grandkids. Now remember, your spouse is not to the side. Your spouse is part of the vertical line, because your spouse, when you married, the two shall become one. So you're one with your spouse, okay? But your extended family, your siblings, your nephews, aunts, cousins, and so forth, you can actually engage in a business transaction with them using your retirement account. Now let's go to the next slide and let's actually dig a little bit deeper and look what those transactions are. Let's go to the end of this slide. So let me just go over that and go one by one. Number one is a sale, exchange, or leasing of the property between a plan and disqualified person. Now, example of that can be a question that comes up once in a while. Somebody comes to me and says, hey, I do own a property personally. Now I have a self-directed solo 401k. Can I sell this to my 401k? Well, the answer is no, because that will be a transaction, a sale between the disqualified person and a qualified plan. That is not allowed. Next example is lending of money or extension of credit between a plan and disqualified person. Again, if you're buying a property in your retirement account and you're short, you personally cannot lend money to your 401k. And if you're buying a property in your retirement account and you get a loan, you cannot qualify for that loan, or you cannot guarantee that loan. That's why the loan must be non-recourse if you're buying a property. Providing goods or services between the plan and disqualified person. A good example will be if you're a real estate agent and you have a solo 401k and you're buying a property, investment property, guess what? You cannot actually represent your 401k in this transaction. Somebody else has to do that. You cannot, regardless whether you get paid or not. That's providing services and that's not allowed. Next, transfer to or use by for the benefit of a disqualified person of the income or assets of the plan. A good example can be when you decide to buy a vacation rental in your 401k as an investment, and you rent it out on nightly or weekly basis. Let's say it's somewhere in Florida or even, anywhere. Well, you personally not allowed to stay in that property because you now will be receiving benefits from the plan assets. So that's not allowed, regardless whether you pay market rent to stay there or not. The fact that you're using it, that's what makes it prohibited. And lastly, receiving any consideration for your own personal account. So all the income that investment generate, it must be for the benefit of the 401k. You cannot use that personally. It must benefit the 401k or an IRA. All right, let's jump to the next slide. Buying real estate inside of an IRA or 401k is fairly straightforward. Again, the owner is the qualified plan. All the gains and all the income that you receive, sheltered from taxes. So you pay taxes at the future date, and the main benefit here is the compounding. So because you're not paying the taxes on the income and gains, you're able to grow your wealth much quicker. So you can accumulate more at the end comparing with the taxable account. If you do it inside of a Roth, it's completely tax-free. And remember, all the income must go back to the account and all the expenses must be paid from the account. You can't use for any related expenses to the investment personally. All right, let's move on to the next slide about financing. I did mention because as a disqualified person, you're not allowed to provide a personal guarantee. The loan must be non-recourse. Non-recourse meaning that you don't provide a personal guarantee, property is the only security for the loan. Typically, those types of loans require 30 to 50% down. Property will be the only security for the loan. You must have enough reserves, and in an IRA, it will trigger unrelated debt finance income tax. Okay. Now, it does not apply on a syndication where you're not buying a property directly in your 401k. So the financing is going to be there already. You just partner in and you're investing a small portion into the LLC. So that's if you're buying a property directly. All right, let's jump on the next slide. Just a quick comparison between the three options. you can use either one of them to do non-traditional assets, but you do need a custodian for an IRA. 401k does not require a custodian. You have checkbook control with IRA LLC or a solo 401k. There is transaction fees with the custodian IRA, and they're eliminated with the IRA LLC or checkbook IRA and a solo 401k. But with the LLC or middle option IRA LLC, you do need an LLC, so there's additional cost for the LLC. You can borrow money only from the solo 401k, cannot take a loan from an IRA, even a penny. If you take a penny or a dollar from your IRA, that will be distribution, taxable event plus penalties. Leveraged real estate will result in unrelated business income tax in an IRA only. 401k is exempt from that. Again, summarize the contributions. As you can see, solo 401k, one of the main benefits is the tax shelter. So significantly higher contribution limit, almost 10 times higher. And with the solo 401k, there is actually a built-in ROD that allows you to make post-tax as well as pre-tax contributions. And last is that solo 401k is not for everyone. You must be self-employed or own a legitimate business with earned income. So it's not for everyone. If you qualify, great. If not, look at the IRA options. All right, let's jump to the next slide. And basically, this is a link or a screenshot of my calendar. I know we had a limited time, and I think we might have a few minutes left for some questions, but each one of your situations is unique. So, and obviously it's impossible to do it in the public presentation like this, but I do offer you ability to have a complimentary one-on-one talk with me where we can look at your specifics, and I can help you maybe create a strategy that will work for you. So you can easily schedule this by going to our website and booking the time in a real time. And I think the next slide will show you my contact information again. My email and my phone number, feel free to reach out, or you can do it on our website. You have that information on our website as well. So, Alex, how are we doing on time? Do we have any?
Yeah, I think we have about 10, 15 minutes left. Okay. We'll be sharing the presentation with you guys in recordings. So if anybody has registered and has joined us utilizing the webinar via Zoom, we'll be sharing the recording so you can watch or share with others as well. And the Dmitry contact information is going to be also included in the system for you guys as well. So we do have a couple of questions that came in live, or some of the people actually could not join. I guess one of the question was from Alex as well, is having more of a strategy. What's your take right now on investing in real estate, even utilizing your retirement fund right now? Because of COVID-19, there is election, uncertainties. If anybody could address that and just share their personal opinion. Tim or Dmitry, you're more than welcome to chime in.
So is that a question for me?
Tim or Dmitry, just, is this the right time to invest in real estate, utilizing retirement funds, or should we wait?
I think it's a perfect time right now. It's a perfect time because there are more opportunities coming to the market. We've seen deals popping up in different states, in Georgia, Florida. Florida is pretty hot, actually. We expected sellers to drop their prices by 20, 30%, but from people on the ground, we've been getting maybe 5% discounts on properties, and sometimes 10, and even those fly off the shelves within weeks, actually the first week or so. So I think it's a great time to invest right now.
Yep. Yeah, we're also in the process of closing 3 different syndications. One in Charlotte, we're very bullish on Carolina market, Phoenix, Arizona, and we're just closing on a portfolio deal of 12 properties in 3 different states. Just as a rule of thumb, Tim and I will look for locations where they're growing in population, they're stable as far as the rent, demographics, where there is a cash flow component involved. We do not invest in expensive states where they're also not business friendly nor lender friendly. So for example, I'm in California. It's a very expensive place to live and very business unfriendly. Unfortunately, there's a lot of people moving out. The rent has been dropping in Silicon Valley and New York specifically. So we're following the trends and we're seeing a very high demand for apartments specifically in Sunbelt states and Texas. A lot of people are moving out from expensive areas. As you know, a lot of people have moved out because of flexibility of working remotely. We don't know whether this is a permanent move. Maybe some people will come back or not, but this is the areas that we're focused on. We're looking for cash flowing, light value add opportunities as well. We do have opportunities coming up in the near future. So you can contact me and Tim and sign up for our investor club as well, located at the Wealthy Mind Investor Club. If you'd like to co-invest with us, every now and then we have opportunities that come in that we can bring our investors. We host webinars and we go over the business plan. You get to meet the main sponsor as well, ask questions, and then if you decide to move forward, you can go ahead and invest with us. Another question, I think from Facebook just came in, is that can you clarify the difference on a dollar amount? I think the person was confused. Why is it so high versus a traditional 401k of $14,000 or $18,000? Is it $63,000, and how is this calculated?
Yeah, so solo 401k has a maximum limit of $63,500, and there is actually two components with the contributions. The first component is your elective deferrals. That's what you contribute as an employee, and that limit is $19,500. So if you have a 401k at your employer, there is the same limit. You can put up to $19,500. Now, this component is across all the plans. So this is a limit per individual. So if you do have a 401k at your job and you put maximum there of $19,500, you won't be able to put any more as an employee in the solo 401k because you already reached the maximum. If you put in, say, $10,000 at your employer 401k, then you can still put additional $9,500 for a total of $19,500 into the solo 401k. But then on top of that, solo 401k has what's called the profit sharing, because it's a 401k / profit sharing plan. And the profit sharing component allows you to contribute up to 25% of your compensation for a combined maximum of $57,000. Okay. And then if you're over 50, then you have additional $6,500 catch up, which makes it $63,500. So that's how this number is calculated. It is based on your income. So not everybody is going to be able to put the maximum, but you can maximize that pretty quickly, much quicker than with the SEP IRA. And if you look at the total, it's almost 10 times higher than an IRA. So it's a great tax shelter. I mean, I don't ask me how IRS came up with this or Congress or whoever.
They have some kind of formula, I guess.
Made those limits, but those are the limits. And, you know, I don't care how they come up. All I care is how much I can contribute, how much it can benefit me.
I mean, it is still very surprising, to say the least. I didn't know about that until 5 years ago, that you could invest in retirement funds utilizing real estate. For the most part, it's a black hole. A lot of people are not aware of it. Super wealthy, uber wealthy have been doing it for many, many years. And I'm glad that we're able to learn such strategies and share that with others. So we have another question from Olga. Olga is a CPA and a real estate investor located in the area. She's asking a question about how do you administer RMD when and if liquidity is tied up in real estate, assuming most plan assets are in real estate?
Yeah, good question. Well, you know, RMD now been moved to 72. It's been 70.5, so now it's pushed up even further. So RMD doesn't start tomorrow, okay? I mean, you'll know when you're going to hit RMD. And the point is that you need to plan for it. Don't wait until you're 61 and a half, and then, you know, a few months later, you're forced to take RMDs and you don't have any cash to take. So you want to plan for that. Make sure that you have enough cash. Obviously, it's going to be a lot easier to do it that way if you plan and you do have liquidity. But even if you don't have liquidity, it's possible to do what's called the in-kind distribution. So rather than taking out a cash from your 401k, you can take asset out. Now, obviously, you will have to, it's going to be more complex and more work. You will have to basically get the third-party valuation on the asset. So there's going to be additional cost involved. But you can take the property or certain asset out of the 401k as a distribution. So for example, if you're invested in a syndication, you will have to value that investment in the year when you take a distribution, or actually in the month that you take in a distribution, and then that amount will go on a 1099. That will be taxable income, assuming that's you're taking it from the pre-tax. If it's a Roth, it's going to be tax-free.
Dmitry, would you clarify what RMD is for our listeners, please?
Yeah, RMD is a required minimum distribution. So IRS says that when you reach age 72, it's gone up from 70 and a half, I think, about a year ago. Then you are required to take X amount from your retirement account. Now, Roth IRA is exempt from that, so it doesn't apply to Roth IRA, but all other accounts, you are required to take the required minimum distribution every year. And it's calculated, your CPA will help you calculate what that number is. And it's based on your age, life expectancy, and the balance in your account. And 401k distributions will be calculated separately from an IRA. So if you have several IRAs, you can lump them all together and you can calculate RMD, and you can just take RMD from one of the IRAs. But if you have a 401k, you cannot do that. You have to calculate RMD for an IRA and then separately for a 401k.
Great question. Great answer. Thank you for clarifying. Yeah, so we've had some additional questions that came in. Yeah, we know that a lot of people are moving out. There is a big migration, especially to Florida, Texas, Arizona. So these are the opportunities that we definitely follow, and this is where we're investing. We are looking at market trends and following that. So as Wayne Gretzky said, some of you might be familiar with a hockey player, we have to anticipate where the puck is going. So this is where we are evaluating our deals with our partners, and this is where we're investing as well. Another question came in is, can the individual co-invest in the same deal asset with his or her solo 401k or self-directed IRA?
Good question, although there is no simple answer to that. If you're investing in a syndication, for example, then you certainly can. I mean, you can invest $50,000 from your solo 401k, and you can invest another $50,000 personally, because it's a smaller percentage. Now, if you're talking about buying a property 50-50 with your retirement fund, that creates a problem. Theoretically, you could do that. So basically, you own 50% of the property. Your retirement account will own another 50% of the property. But that's not something that I will recommend, because remember, you are a disqualified person to your retirement account. And now you're co-investing, which might be okay at the very beginning, but because now disqualified person is involved in the transaction with your retirement account, or owns an asset with a retirement account, it can potentially create problems down the road and can potentially lead to a prohibited transaction, even if it isn't at the beginning. So that's not something that I will recommend. Make sure that all the transactions are arm's length, that your 401k is involved.
Also, can I add one more thing, Dmitry? You're absolutely right. Also, there are two types of investors: limited partners, and you can certainly invest in deals as a limited partner using your 401k or solo 401k. But if you're going on a deal as a general partner, you can only invest as a general partner and you cannot use your IRA 401k. It's actually considered to be a prohibited transaction by IRS. So a general partner, just like an active investor participating in a joint venture deal or investing his own investment, cannot use 401k IRA money.
That's good. Yeah, thank you for clarifying. Let me see if there's any additional questions that came in through Facebook. Please type your questions in the Q&A, and then we have a couple of minutes left before we end the live session.
Here's one question, Dmitry. How late or when can people currently already enrolled into self-directed IRA switch to solar 401k, or in general, when can they start their solar 401ks or self-directed IRAs? Could you elaborate on that? That's a question.
Well, you can set up self-directed IRA or 401k at any time, but couple of things to be aware of. For example, if you're mainly the timing will apply to the 401k, okay? Because if you, for example, if you own a business and you're looking at the ability to minimize your tax liability and you want to contribute maximum allowed amount to the solo 401k, then if you want to do it for this year, the plan needs to be established this year. Whereas an IRA, for example, you can contribute to an IRA or you can open an IRA past January 1st and contribute for the previous year. Well, a portion of the contributions in the 401k can also be made after the year end, so after January 1st, but the plan must be established before December 31st. In other words, if you don't have the plan established by 12/31, then you cannot take advantage of that for that year.
Right. Yeah. Another thing I wanted to add is when we do have periodically investment opportunities, please do not call and ask to establish 401k and invest in the deal. This process takes time. This is not a 1 day or 1 hour type of involvement. Please contact Dmitry and understand the process involved in that. This does take several weeks. As well. So if you are planning to invest in the near future, you need to start planning today or tomorrow, because this process does take time, and you will miss out on opportunities just because you took time to establish solo 401k as well. I do not have any questions. So does anyone else? Let me just double check to make sure that we were able to answer all the questions. I do not believe so. If you'd like to learn about our upcoming investment opportunities, please join Investor Club. I'll be sharing that information with you. You can enter your personal information and your email and phone number. We'll be contacting you in the near future when the deal does come along, so you'll get a notification from me and team as well on upcoming opportunities. We'll be sharing the recording with you as well, and our contact information, including Dmitry. If you have any other further questions, please get in touch with us. Thank you everyone who was able to join live, and we're looking forward to be connecting with you in the near future. Thank you, Dmitry, for your time.
Thanks, Alex and Tim, for having me.
Thank you.
Thank you, everyone. Have a great evening.
Bye.
Bye-bye.